Welcome to the exciting world of Chapter 9. What we're doing in this chapter is jumping over the equal sign in our accounting equation, A equals L plus E. And for the remainder of the semester, we're going to be focusing now on our L's and our E's. So Chapter 9 focuses on some of our liabilities, as does Chapter 10, which focuses on a specific type of liability, bonds payable. And then we'll move into equity and cash flows. So again, we're continuing our drill down into the various items on the balance sheet that we've already talked about in overall detail at the beginning of the semester. Now we're getting into more of the nitty-gritty nuances that are associated with these different accounts. The good news is a lot of the stuff we'll talk about in this chapter and beyond should be familiar and should be a review, and then we'll just take it up a notch with a few new concepts. So let's go back to the beginning of this semester where we talked about how you or I get our money to live. And we said in order to get our assets, we either borrow money, which would be our liabilities, or we earn it ourselves, which would be the retained earnings part of equity, or people give us money, our parents give us money, friends give us money, and that would be our contributed capital. A business is no different. They obtain their assets either by borrowing the money, earning the money themselves by selling goods and services, or by getting money from investors, which is their contributed capital piece. The breakdown of a company's debt and equity is referred to as its capital structure. The debt is the amount they receive from creditors, and of course we have to pay that back, and then equity is the amount from owners. From the firm's perspective, the company's perspective, debt is considered more riskier than equity. Why? Because you have to pay debt back, whereas with equity you don't have to give the owners their money back. Creditors can also force you into bankruptcy if you refuse to pay them. Creditors can also require the sale of assets. Think of repo men and women going out and taking your assets back if you're not paying your debts. And in addition, it's not shown on the slide here, but debt also requires the payment of interest, which equity does not. Remember, dividends can be paid to the owners, but dividends are never required. Therefore, dividends are not expenses. Interest, on the other hand, is required and is an expense. So again, that adds an element of risk to the business, because not only do they have to pay back the amount borrowed, they have to pay back an extra amount, the interest, which is what's charged for allowing the company to utilize the funds. So let's talk about some different types of liabilities. First, we'll review some current liabilities. Current liabilities are liabilities that we have to pay within the next year. Why is that important? Because we need to have enough current assets in order to meet those obligations. Long-term liabilities would be our liabilities that are due in more than a year. And it's important to remember that a loan can have a current and a long-term portion. For instance, I have a car loan on my truck, and the amount I owe within the next year would be the current portion of that loan, but then any amount I owe after that would be a long-term liability. Liabilities are recorded at their current cash equivalent value, which is the amount that the creditor would accept to settle the liability immediately. That's nothing complicated. It sounds like it could be, but it's just whatever the value of the loan is at the current period of time, which is usually the principal amount of the loan. So current liabilities are created generally from our various operating activities, and there's some examples on this slide of what that might look like. So if we purchase coffee inventory and we're Starbucks, so that's the coffee, that's going to create accounts payable if we don't pay for it right away. If we rent store space for the coffee house, that could create accrued rent if we haven't paid for it in advance. As our employees work for us, that's going to create accrued wages until we pay them. And then if customers pay in advance for future purchases, for Starbucks, that would be like buying a gift card or loading money on the app. Then that would be considered a deferred revenue, because the store would owe future services, food and beverage, to the customer when they turn in their value card or their gift card. Accounts payable, we've talked a lot about. It occurs anytime we purchase something and don't pay for it right away. It's also called a trade account payable. You can read the definition on your own, but we should be familiar with what an account payable is at this point in time. Accrued liabilities is just any liability that results from an accrued expense, which is when we use something and don't pay for it right away. So some examples of that would be like salaries and wages or utilities that we don't pay for right away. We use them and we pay for them after. After equals accrual. Remember that good stuff we learned way back? Well, that's how accrued liabilities are created. Deferred revenues, known as unearned revenues, are created when we get money before we earn it. We talked about like airlines getting cash before they fly you. So they'd have an unearned revenue until they provide you with that flight. And the note payable is different than an account payable because it's more formal, and it involves usually the payment of interest. So there'll be a formalized contract basically stating the amount that you're borrowing, the interest rate, and how long you have to pay it back. When you get paid from your employer, you may make $10 an hour, but as you probably know too well, assuming you're paid above board and not under the table, that you don't get the $10 an hour that you earn because the government sucks out money. So the company that is paying you has to pay certain taxes on your behalf, and they also have to pay additional taxes that it becomes an expense for them. So it's important that you understand this for your own futures, because when you're getting paid $10 an hour, hopefully a hell of a lot more than that once you graduate, and if you work 40 hours, your gross pay would be $400. But that isn't going to be your net pay, because what happens is the government comes in and they take what's called FICA tax. FICA tax is Social Security and Medicare tax. I call it old people tax. Now, that may not be a politically correct way to address it, but that's effectively what it is. The Social Security is the forced government retirement, so you put money in through Social Security, so when you become of age, usually 65, you can start drawing on that money. The system is flawed, though, because basically the money that we're putting in today as we work is getting used to pay my parents and maybe your grandparents their Social Security. In theory, it should be invested today for us to use in the future. But the Social Security system in the government is flawed in that they don't have any money from the past, so they're using current money to pay the past people that also put in money when they were younger. But Social Security is the amount you get in your old age in the United States, and then Medicare is insurance for people that are over 65 that's supplemented by the government. Bottom line, what you really need to know is that it's sucking out 7.65% of your salary. There will be no question on the exam where you have to memorize that percentage, but isn't it kind of important for you to know where your money's going? So 7.65% of your money gets sucked out, and then on top of that, your employer has to pay another 7.65%. That's why sometimes employers want to pay people under the table, because they get to save on that payroll tax. It's illegal, but companies do illegal things all the time in order to save money. In addition, you have federal income tax withheld, so you're going to have to pay federal income taxes on the money you earn. A lot of times you get it back if you don't earn a lot of money. You may get all of that money that's withheld back at the end of the year, but it still gets sucked out of your paycheck initially. And then if you don't live in our wonderful live free or die state of New Hampshire, you live in Massachusetts or some other state, you're probably paying state and local income taxes as well. And then finally, that leaves you with the net pay that you get. So in our little example, gross pay is $400. And then just for rounding purposes, we're going to say that the employee portion of FICA is 32. I just took 8% times 400, just rounded it. And then federal income tax withheld is, say, 100, and then state and local income tax withheld is 50. So what that means, and I should have rounded a little more with that 32, I should have made it 30 to make my life easier, but I got my trusty HP 10B, so I'll subtract, and what that means is your little paycheck is going to be only $218, which is a little sad, but true. So how is the employer going to deal with this? Well, they're going to record salary expense like we would have back in the old days before we talked about these taxes of $400. So their expenses go up by $400. They're going to have FICA payable of $32, increasing their liability. They're going to have federal income tax payable of $100. They're going to have state income tax payable of $50. And then finally, they're going to have wages payable of the net amount, which is $218. So basically, all that's changing is who gets the money. So rather than give the employees the full $400 in wages, they're going to end up having to give the government a good chunk of that money, and then the net pay to the employees is what is classified as wages payable. In addition, the company is going to have FICA expense because they have to pay the same amount that the employee pays. So the employee paid $32, it got sucked out of their paycheck. So the employer is going to have an expense for that same $32 that they have to pay, which is going to increase the FICA payable by the same amount. So now we have another expense and another liability as a result. And then on top of that, there's unemployment taxes at both the federal and state level that need to be paid. So that is going to create another entry that's going to be federal, state unemployment tax for whatever amount that is. Let's say that's $40. And then you're going to have federal, state unemployment tax payable by the same $40. So in order to have employees, it's actually more expensive than the $10 an hour that we pay them. In addition to the $10 an hour, we also have to pay for FICA, which is the Social Security and Medicare. We have to pay 7.65% of the salary. The employee pays it and the employer pays it, so the total comes out to 15.3% that the government takes for that, half from the employer, half from the employee. And then we have to pay federal, state unemployment taxes on top of that. And then in addition, there's usually benefits that are involved. So there could be health care benefits or retirement benefits that the employer pays on their employees' behalf. So all of that affects the way we record the journal entries. We're not going to worry about the retirement or medical benefits. We'll focus just on the taxes that get sucked out of our gross pay. And you should be responsible for recording these entries. These entries aren't anything really new. The concept of these taxes might be new, but the concept of using up an expense and recording a liability is not. So with a little practice, this should be pretty easy to grasp and understand. Deferred revenues happen when we receive money before we earn it. So if Starbucks were to receive cash from customer purchases of gift cards, they would get cash. I'm just making up the number, 100, and then their unearned revenue would go up 100. So initially their assets go up and their liabilities go up. Then when they earn it, they would debit the unearned revenue. Let's say they earned $50, so that decreases their liability. And at that point, when they provide the coffee, that's when their revenue would go up. So when a company loads, or a customer rather, loads money on a gift card, Starbucks isn't earning anything at that point. They have a liability. They have to provide future coffee and food and the like. And then when they do provide that future coffee and food and the customer turns in their gift card or scans their app on their phone in order to pay, then at that point, that's when the company earns the money and revenue is recorded, which reduces the unearned revenue liability. This is a 100% review. We covered this in adjusting entries in Chapter 4. The next thing we're going to talk about is the accounts payable turnover. This is kind of like the inventory turnover and receivables turnover that we talked about before. To get accounts payable turnover, we're going to take cost of goods sold over average accounts payable. Average accounts payable is the beginning account payable plus the ending divided by 2. If we had an account payable turnover of 6, I'm just making up that number, then that means that on average the company pays their suppliers 6 times per year. That really doesn't help me understand what's going on, so we can convert it to days to pay. So we do that by taking 365 divided by the turnover, and that would tell me that on average this company, based on my fake number I made up, takes 60 days to pay their liabilities. Now that seems kind of like a long amount of time, so we need to compare that to the previous year or to other companies in the industry to determine if that is reasonable or not. But as a general rule, we want to see the turnover high and the days low, because the quicker the company is able to pay off their debts, the more liquid the company is deemed to be. You don't want to see a company struggling to pay off their obligations as they become due, because that could indicate that the company could run into trouble with liquidity, meaning that they won't be able to pay their debts on time and could be forced into bankruptcy in the long term if that keeps up. So a healthy company is going to have a high account payable turnover, which in turn would result in a lower number of days to pay.